Hi, in this video we are going to talk what is the money flow index and how does it work. The money flow index is a popular momentum indicator that is used to identify overbought and oversold market conditions. Learn more in our guide to the MFI, including why traders use the indicator in their strategies. What is money flow? The money flow index is a technical oscillator that measures the inflow and outflow of money into an asset over a period of time. It looks at both price and volume to assess the buying and selling pressures in a given market. Analysts found that volume alone was not a clear gauge of momentum. What traders should really be interested in is the market response to price changes. This is why the MFI also looks at price movement to confirm whether there is a longer momentum upwards or downwards, indicating the sentiment of the market. How does the money flow index work? The money flow index works by oscillating on a scale from 0 to 100. The figure presented at the end of MFI calculation will be plotted on this scale to provide overbought and oversold signals. If the MFI reading is above 80, the market would be considered overbought, while a reading of 20 or below is a signal for oversold condition. On the IG platform, if the MFI exceeds 80, the line will show as red, and if it falls below 20, it will appear green. The theory behind the MFI indicator is that when these levels are met, the market price could soon reverse, and traders should think about opening a position to take advantage of the momentum. It is also important to keep an eye out of for points where the price of an asset and the money flow index are giving contradictory signals. This is known as a divergence. For example, if the price is making new highs but the MFI doesn't reach corresponding new levels, this would be a bearish divergence. It indicates there may soon be a selling pressure. However, if the price falls to new lows, but the MFI doesn't follow that movement, it may be an indicator of a bullish divergence and an impending buying pressure. It's worth remembering that a divergence doesn't always result in a reversal. The MFI can produce false signals. This occurs when the indicator presents a good trading opportunity, but the market price does not move as expected. This can result in unexpected losses if a trader hasn't implemented a suitable risk management strategy. Money flow risk calculation. Most traders will never have to calculate the MFI themselves, as usually online platforms will do this automatically. But knowing the steps involved in calculating the MFI is a great way to understand exactly what the indicator is showing you. Although the MFI formula can appear complex, Once broken down, it becomes an accessible way of measuring market conditions. We've outlined the process for calculating the MFI in five simple steps. The typical price is calculated, the raw money flow is calculated, the positive and negative money flows are calculated, the money flow ratio is calculated, the money flow index is calculated. The typical price is calculated. To calculate the typical price for each trading period, you need to find the average of the high, low, and closing price. The calculation for this would be the raw money flow is calculated. The raw money flow is simply the approximation of how much capital was passed through a market in a given period. Whether this was buying the assets or selling it. It is calculated by taking the typical place and multiplying it by the volume for that period. The volume is usually measured using the tick volume, which represents the amount of price changes over a given period of time. This is because not every market gives real volume reports, which provide data on how many times an asset is bought and sold. The positive and negative money flows are calculated. Once you have calculated the raw money flow, you will be able to determine if it is positive or negative. This is done by marking whether the raw money flow in a given period is higher or lower than the period before. If the typical price for the period is higher than the previous period, it is considered a positive money flow, and if it is less than the previous period's price, it is considered a negative money flow. The money flow ratio is calculated. Once you have your positive and negative money flows, you can calculate the money flow ratio. You would do so by adding up all the positive money flows over last 14 periods and dividing this number by the sum of the negative flows for the last 14 periods. The equal looks like this. The money flow index is calculated. Now that you have found the money flow ratio, you can calculate the MFI, the money flow index formula. The money flow index figure will be positive in assets price had predominantly risen during those 14 periods. So that's all for now. Thanks for your view. Waiting for you in my another video and have a nice day. Bye.